Good afternoon, everyone. This is Jason Hilliard with Forecast Capital Management for September 20th, 2022. I wanted to go through a couple things today, mostly data related, as they usually are, mostly high level data that you should be looking for or looking out for. The first one is single family starts and permits. We had a bit of a bounce in U.S. housing starts for August this morning at 3.4% month over month, although they do remain down 14.6% year over year. So the caveat is that the leading indicator permits was down 3.5% month over month and hit a new cycle low. So just know that even though housing starts were positive month over month, they remained down year over year, and permits was down 3.5% month over month. So the U.S. yield curve also, I want you to look at the bottom of this particular chart. We are at the U.S. yield curve hit a new low this morning of negative 0.44%. That is the 2 and 10-year spread. That is a very low number, and it might even go lower than that, but we'll see. A couple other things to note, not as important, but certainly something to keep in mind, is the U.S. Redbook weekly retail sales decelerated to 10.5% year over year from 11.4% in the prior week. Now, it's not really that noteworthy except to say that it's the second lowest reading in 18 months and continues to confirm that the general path is a rate of change slowdown in retail sales. And note that this is also a price indicator. Obviously, volume is probably at best small year over year. So just take note of that. Also, Ford guided their third quarter EBIT down by 50% versus consensus. That's a big deal. And in the announcement, Ford cited limits on availability of certain parts as well as higher payments made to suppliers. That is really the definition of inflation. The other thing I wanted you to take note of is that per the Fed funds futures, and we went over this yesterday, there are now 7.66 hikes expected for the remainder of 2022. And what I mean by that, 7.66, every raise of 25 basis points is considered one new hike. So if we take 7.66 into consideration, that's almost a 2% additional rate hike for the Fed funds futures. So keep that in mind, because tomorrow is when the Fed comes out with their interest rate decision. The other thing is Germany's PPI hit an all-time high today. The German August PPI report this morning was a bit staggering, with PPI accelerating to 45.9% year over year versus 37.2% in July. This was another all-time high and was up 7.9% month over month. The report also crushed consensus, which was at 37.1%. This is happening all over Europe. It's not Germany in particular. It's all over Europe, but Germany is pretty exaggerated. To put it into perspective, the divergence between CPI and PPI in Germany is now has a z-score of negative 7.7. And so the one thing to note on that is PPI always leads CPI. So if PPI is going through the roof, I don't think CPI is over accelerating in Europe, and it's already gone through the roof. So take note of that. Obviously, the big drivers of the PPI number were energy at 139% year over year, natural gas at 209.4% year over year, and electricity at 174.9%. Hopefully, it's not that cold of a winter for Europe, but man, those numbers are staggering. But the ECB benchmark interest rate still remains at 0.75%. So despite these staggering levels of inflation, the European Central Bank really hasn't done anything to alleviate it, and they're really behind the eight ball on this one, even further so than the Fed in the United States. The other thing to note in Germany is we had a big move in European bonds with the German 2-year hitting an 11-year high and the UK 5-year at its highest level since 2008. And also note the Italian 2-year is at the highest level since May 2018. Sweden raises its central bank rate 100 basis points today. The market was expecting 75 basis points. That did not happen. This is a chart showing that their stock market obviously is down 40% from its highs. And also you have the Sweden repo rate rising, I should say. The only, we did get a small reprieve in global inflation, and that's Canada. The August CPI came in this morning, which was slowed to 7% year over year, and 6.3 if you take out gasoline, with the latter being the first monthly decline since July of 2021. Here in the United States, gasoline prices fell 9.3% month over month in August, which obviously helped. But the flip side is that food prices were up 10.8% year over year, which was the highest increase since 1981. So all of these things are very important going forward. Obviously, the Fed and all these central banks have a lot to do with combating inflation, although the majority of them are behind the 8 ball, not the least of which is the Fed. Tomorrow I may go through some interesting details about the Fed and their current quantitative tightening cycle. It may not be what you expect it to be. In fact, there are some really interesting decisions that the Fed has made recently on quantitative tightening of $95 billion a month. So I hope everybody has a great day. If you have any questions, please let us know. You can always email info@forecastcapitalmanagement.com. Otherwise, have a great one, and we'll talk to you guys soon.